talk about the important lesson of selling a covered call real quick. So you have the account balance. This is my small account challenge. I lost $122 trading the S&P 500 today. Let's not talk about that. Let's talk about this TQQQ position. So I'm looking at TQQQ right here, and I have 100 shares right now. This is the 5-minute chart. I'm looking at the daily chart now. When I zoom out, let me get rid of some of these drawings so you can see it more in a clear view. I'm seeing a nice little downtrend break, right? So it broke down this downtrend. It might run up a little bit. It has a gap fill up to 26, 27. But I think that there's a lot of looming bad news coming this week with Federal or Jerome Powell talking, whatever it may be. But I think it's going to come down because it's up almost 10% today. So I'm collecting that profit, and I'm not really collecting that profit off the 100 shares, but I kind of want to lock it in there. So what I'm looking at right now is I want to sell a call, a covered call against my position. So when you trade options, you just go to the trade tab. You look at the TQQQ against the shares that you have. So I have 100 shares here, and I sold one call here to protect myself. So instead of paying for this premium, I collect that $200 and it goes directly into my account. Now it is T+1 settlement, so it'll show in your cash that you have that $200 collected, but it'll show in your net liquidity and day trades up here the next day. So it has to settle first. So every call that you sell is worth 100 shares bundled up into one contract. So this is called a covered call. So now I have 100 shares at this cost basis, a little bit higher than what it's trading at right now after that big downfall yesterday. But now I think it's going to come down a little bit more. So I'm going to sell a covered call and collect that $200 in premium. So I go to the trade tab. I look for the date that I want. I did a little over 2 weeks out just because it was more expensive, and I think we're going to come down. And the best part about this is implied volatility percentage and theta become your friend. So you're kind of playing with the house here. You want a high implied volatility percentage in this because it shreds the contract over time. So if we come back down to that $22 level, then these will be worth literally under $100, $90, and as it gets closer, it'll continually expire. So I can buy back these contracts at any point. So if it goes down to 100 and I want that $100 instead of the 200 and waiting the extra week, then I can just buy back that contract for the contract value because I'm short it basically at 200, buy it back at 100, then I can keep that 100. But if it's in a really bad bear market, then I'm just going to let it expire to zero and collect the full 200. But you need to have 100 shares directly for that. So what I do here is I just go to the options chain, and usually I would just right click and buy it or go to the active trader. But here you're going to right click, sell, single, boom, and you only have 100 shares, so you're only going to be able to sell one because it's wrapped up into 100 shares. Do not sell two because then you will end up bearing yourself if you're not doing it correctly. So what you're going to want to do here is you're going to want to do this. Find out the strike price or the limit price that you want to sell it at. You can sell it at market if you wanted to, but around $200 is how much money or how much premium I wanted to sell it for. So I'm the seller. I'm looking for somebody out there that wants to buy these contracts. So if they're bullish on the TQQQ, then they're going to buy it from me. So I sell it to them, collect that $200, goes in my account, and then from there, my shares are basically my collateral. So if it goes up to 28, then my 100 shares, I have to sell them at this $25 strike price. So it's a little riskier trying to sell them at the money or near the money, but in my opinion, I think that we're going to come down a little bit with all the news that we have going on. If we end up short squeezing, I could always buy this back for more expensive. So if it's worth $250, $260 in a couple days, I could sell it or I could buy it back and make back $60. But for this example, I have 100 shares and I think it's going to come down. So I'm going to sell one. I sold it at 200, and then you could just do it, confirm and send, boom, it'll go in. I just did this, so I'm going to hit delete instead of confirm and send. But I go back to my monitor tab and I sold short one here at 200, and it's now worth 206 because the market's kind of ripping right now. So I'm down $6 on the put, but I'm making money on the shares. So as this expires and gets closer to its expiration date, I will slowly collect more premium as it falls. If it continues to increase on me, I'll obviously be gaining onto that premium. But then from there, if it expires in the money, then I will have to sell my shares at 25 rather than, let's say it's trading at 28. So I miss out on $300 there, but I collect that 200. So it's really only a $100 risk. And then from there, I can decide if I want to get back in my shares or not. So very unrisky strategy, and it's a good way to make income on the shares that you're holding, especially if you think things are going to start coming down. And when you're holding something with high implied volatility percentage, it's going to shred those contracts. So it's really a great position to be in. So I hope that helps. All you really do is just go to the trade tab after you have 100 shares and then right click, create closing order, or not create closing order. Just right click, hit sell instead of buy. Instead of buy single, you're going to go to sell single, and then just sell one at whatever price you want to collect. So the hardest part is figuring out which strike you want to get and being on the right side, of course. But with the way the market's going and a lot of the news events we have coming out, I think it is a great opportunity to just collect a quick $210. So that's it. That's it for my TQQQ setup. But the best part about this, I'll end it with this, as that TQQQ is a triple leverage ETF, and it's very risky to play these, but I am a big fan of what's going on right now in the market. So as this gets more expensive, like up to $40, $50, whatever it may be in the TQQQ, so do these premiums, and they'll be worth 600, 500, 400. Then I can continually collect 400 once a week or 500 once a week per 100 shares. So you do the math there. If I'm collecting $400 once a week, I'm making $1,600 a month just by holding shares if I'm selling them on the correct side and they expire worthless. So super good opportunity in my opinion, especially when it's this low. My favorite opportunity in the market, because if I can get up to 1,000 shares, which is really only around $28,000, $21,000, which is quite a bit, obviously, but you can start selling 10 calls, and if they're worth $200 a piece, you can collect $2,000 every single time, and that's $8,000 a month. So if they expire worthless, of course, it's a little bit harder than I'm explaining it about, but great way to make short-term cash on the money that you're already holding for the longer term. So hope that helps out. Hope that doesn't confuse anybody. And if you have any questions, let me know.